Good morning and welcome to the Morning Bell. I'm Robert, joined as always by Lizzie and Steve. It's Tuesday, August 11th, 2026, and we've got a packed show this morning. Markets are treading carefully ahead of tomorrow's critical CPI print, oil is complicating the Fed's path, and Riot Platforms is exploding pre-market on a blockbuster AI deal. Let's get right into it. Lizzie, futures are modestly mixed this morning and everyone's eyes are on Wednesday's CPI print. How would you describe the overall trading mood heading into today's session?
Morning, Robert. The mood is cautious but not paralysed. Traders are essentially in a holding pattern, waiting for tomorrow's July CPI to set the tone for the rest of the month. Nasdaq futures are up about 0.3%, S&P 500 futures up 0.2%, but underneath that surface calm, you've got retail sentiment on SPY sitting at neutral and QQQ reading extremely bearish on StockTwits, which tells you conviction is pretty thin right now. On the technical side, SPY is leaning bearish this morning. Price has pushed right up against the upper Bollinger Band near that 773 level, which historically acts as resistance, and with momentum approaching overbought territory, the setup favours caution for anyone looking to chase this move higher.
Brent crude is sitting near 87.75 a barrel, up over 12% from last week's lows on US-Iran tensions around the Strait of Hormuz. How much is that oil move complicating the picture for equity traders right now?
It's complicating it significantly, because what the crude move does is reignite the sticky inflation narrative right as traders were starting to feel better about the Fed's path. Cleveland Fed President Hammock has already warned that multiple rate hikes may still be needed to get to that 2% target. And when energy prices surge like this, it makes it very hard for policymakers to signal any comfort on inflation, which is why 10-year Treasury yields jumped 6 basis points to 4.71% yesterday, putting pressure on rate-sensitive equities and growth names alike.
There are reports this morning that the US and Iran may have reached some sort of arrangement toward a peace deal. Does that change the calculus at all, or is the market too skeptical to buy it?
The market wants to believe it, but it's approaching the headlines with real skepticism. President Trump has signalled he'll seek war reparations from Iran, and Tehran has its own compensation demands as conditions for reopening the Strait of Hormuz, so the impasse looks far from resolved. You're seeing Dow futures tick higher on the news, but until there's something concrete on paper, I'd treat any geopolitical relief rally as fragile and short-lived.
Walk us through the earnings calendar this week. Where does the real risk lie?
So today, we actually get CoreWeave reporting, ticker CRWV, and the street is expecting a loss of about $1.21 per share on $2.6 billion in revenue. So the bar is already low given they missed estimates last quarter, and any commentary on AI infrastructure demand will be closely watched. Tomorrow, Cisco reports with consensus at $1.05 EPS and $16.8 billion in revenue. A beat there would be a solid read-through for enterprise tech spending broadly. Then Thursday brings Applied Materials, where the street is looking for £3.39 EPS on $9 billion of revenue. And given AMAT's exposure to AI chip manufacturing equipment, that print will be closely watched as a signal for the entire semiconductor capex cycle. On Holdings' 15% pre-market drop after missing revenue and citing tariff headwinds is also worth flagging. That's not purely company-specific. It's a warning for consumer discretionary broadly, that tariff pressures and a softening consumer are a real earnings risk this cycle.
Steve, CPI drops tomorrow morning. The last June reading came in at 333.95, actually below the prior 335.12. What are traders watching for in the July number, and what does it mean for the Fed's September decision?
What the market wants to see is continued disinflationary momentum, and that June print, which came in below both the prior reading of 335.12 and the forecast of 334.7, was genuinely encouraging in that respect. The problem is that July's data is being compiled against a backdrop of significantly higher energy prices, and that oil surge we've been discussing could easily show up as upward pressure in the headline number, making it harder to read the underlying trend cleanly. If July CPI prints hotter than expected, it substantially raises the probability of a Fed rate hike at the September meeting, which is why this release carries very high volatility impact. It is the single most important data point of the week for rate expectations.
Beyond CPI, we've got PPI on Thursday and retail sales on Friday. How important is that full data sequence, and is there a number that matters more than the others?
That full sequence this week is as important a macro week as we've had in months, because together CPI, PPI, and retail sales will paint a complete picture of both the inflation pipeline and consumer health simultaneously. PPI on Thursday is particularly useful as a leading indicator. It tells us what's happening at the producer level before it filters through to consumer prices, so a hot PPI print after a hot CPI would compound the hawkish Fed narrative considerably. Retail sales on Friday then gives us the demand side of the equation, and with consumer confidence last reading at 55.2 and forecasted to slip slightly to 54.5 this Friday, alongside the University of Michigan Sentiment Survey, there's a real question about whether consumer spending is starting to fade under the weight of elevated rates and inflation uncertainty. Also on the calendar today, existing home sales for July with the forecast at 4.05 million units, down from 4.09 million in June, which would be consistent with ongoing pressure from 10-year yields near 4.71%, making mortgage financing increasingly difficult for buyers.
Lizzie, the big pre-market story is Riot Platforms surging over 18% on that $9.1 billion Anthropic deal. Is this a Riot-specific trade, or does it lift the entire crypto mining and AI infrastructure space?
It's lifting the whole space. CleanSpark is up over 4% and Hut 8 is up about 3% pre-market, which tells you the market is reading this as validation of the broader thesis that Bitcoin miners can repurpose their cheap power and infrastructure for AI data center demand. Riot itself is up 37% year to date now, and this deal, 20 years, 191 megawatts from its Rockdale, Texas facility, with potential extensions that could push total revenue to $16 billion, is genuinely transformational for their business model as they pivot away from mining.
Bitcoin has now failed for the fourth time this year to hold above $64,000, and altcoins are selling off harder. What does the crypto tape tell you about risk appetite broadly right now?
The crypto tape is telling you risk appetite is fragile right now. BTC is down about 1.2% this morning to around 64,250. ETH is off 1.6% near 1,888, and altcoins like ADA and Bonk are down 5% or more, which is classic risk-off behaviour where the most speculative assets get hit hardest. Technically, all three major coins, Bitcoin, Ethereum and Solana, are reading neutral this morning, with no strong directional signals in either direction. So the tape is essentially saying wait for the CPI catalyst before committing to a directional trade. Solana is trading around $76 with momentum essentially flat. And until we get clarity from the macro side, I'd expect crypto to remain in this choppy, headline-driven range.
That wraps up today's Morning Bell. Remember, this is not investment advice. Do your own research before making any financial decisions. And don't forget to subscribe so you never miss a morning. See you tomorrow.